right, I think we'll get started. Thank you all for joining us today for this, what will be, I know, a very interesting talk. Professor Julian Zelizer will be in discussion with our book author, Sean Vanatta. We're very happy to have him here. He's been on campus, in fact, for I think almost a week now, right? Doing various activities. So this is sort of the tail end. And he'll be speaking on his book, obviously, Plastic Capitalism, which is a very interesting perspective on the history of it, on how we've gotten to where we are today. And Julian, I think, will explore some of the looking ahead as well as the history. So on behalf of the Griswold Center for Economic Policy Studies, the Julius Rubinowitz Center for Public Policy and Finance, the Economic History Workshop, and who else am I forgetting, Pallavi, that's hosting today? Center for Collaborative History. We're really happy that you're all with us. Thank you both for joining us, and let's get started with the discussion.
All right. Welcome, Sean. It's great to bring your student back so you can ask him more questions after he's been gone for many years. And it's wonderful to talk about this book, which is really from the time he started it, and I'm going to talk a little bit about the origins. It was really a wonderful project, original, insightful, and not a widely covered issue. So let's just start with, I kind of remember when you got here, but how did you decide that you were going to talk about the efforts to regulate credit cards and what happened to that?
Yeah. I mean, the story, it kind of starts when I was first trying to imagine what sort of project I wanted to do. And I knew I wanted to do something that had to do with financial history, something that would kind of take some aspect of finance that we took for granted or thought that we understood and kind of turned it on its head, or kind of opened it up and revealed that it was more interesting or more complicated than we might expect. But of course, it's like easy to have the idea that you want to do that and hard to actually figure out what the object of study is going to be. And as I was casting around for ideas, the first, or what ultimately struck me, was that as an undergraduate, I went into credit card debt. I got a credit card from the University of Georgia Alumni Association, which I actually still have today. I had a $1,000 credit limit, which I used. And credit card companies being very nice, they raised my credit limit to $2,000. And I used that as well. And it went up again, and I used that as well. And then probably from that point on, I really struggled to pay that balance down. And as I was kind of thinking about the historical project I wanted to do, my first questions were kind of cultural. So what about American society made me think that that was a good idea as a 19, 20-year-old without income? But I found that to be a really difficult question to answer, because we all make decisions for sort of personal, irrational reasons. It's hard to get at the aggregate from individual experience. And so I ended up pivoting the project more towards regulation. So trying to understand not why we as consumers take certain actions, but how and why it became possible that we had the credit card system that we did, that banks were so heavily invested in getting cards into consumer hands, and that the credit card market was ultimately so profitable for banks. And so that's kind of what I wanted to try to understand, is where this industry came from and how different stakeholders had tried to shape it to sort of match their expectations for fairness in the kind of through the regulatory process.
Okay, so before we get into some of the specifics of the history, one of the things you did while you were a graduate student here is you were interested in other disciplines. You did research for our late colleague, Alan Kruger. You took my mother's seminar in economic sociology. How do you think of the work you do in relation to different disciplines? What did they offer that informed how you think of the questions?
Yeah, I think it's a great question. I mean, I find that history can often be really sort of introspective to the discipline. And when you're interested in something like political economy, or what historians now call like the history of capitalism, you're asking questions that other disciplines are also engaged with. And so for me, being in a sociology seminar with Viviana Zelizer, Julian's mom, was weird for reasons that you can imagine, but also really insightful in terms of seeing how sociologists would work through these questions or what their concerns were in the kind of present in terms of the way that consumers were interacting with credit markets or the way that regulation was shaped. Likewise, working with Alan Kruger, who had been the chairman of the Council of Economic Advisors, it was a way to kind of see into the policy process, to see how economic ideas and kind of like key actors were shaping the way that administrations were dealing with the economy. And so it's those different windows that both help me understand, ideally, how to make my work interesting or valuable to other disciplines, to reach across disciplines. And on the other hand, to get windows into the policy process or into the kind of processes that I'm interested in that I wouldn't maybe get as easily from history or from the archives.
And now everyone has a credit card. Probably everyone in this room. Is there anyone who doesn't have a credit? Impressive. Okay, almost everyone has a credit card. When did the credit cards start? When were these part of the American economic landscape?
So there's a couple ways to think about this. So I'd kind of start us before World War II, and you can think about, on the one hand, department store credit cards, so cards that are largely used by women in a retail context. They're going to be store specific, so you might have a card at Macy's. I don't think Sears had credit cards before World War II, but you get the idea, right? Store cards. And then you have what become kind of travel and entertainment cards, but before World War II are really like gasoline cards. So men, traveling salesmen, might use these. And then as the market develops after World War II, you get banks initially focused on retail credit. So banks have small merchant customers. Those merchants are trying to compete with department stores. And so banks initially develop credit card programs to help the merchants compete. And then you get the rise of travel and entertainment cards, things like Diners Club and American Express, which are really focused on traveling businessmen, people who are going to wine and dine clients, need to be able to have tax write-offs, keep track of the receipts. And so it's kind of in that 1950s moment that these two very gendered markets emerge for credit cards. And what gives us our kind of modern credit card system is the effort by Bank of America to merge them. So Bank of America in the 1950s was a huge bank in California, but it couldn't build branches across the country. And so to compete with American Express, which was national, it developed a system to sign up other banks that would also issue what was called the Bank America card at the time, which becomes Visa. And so because we have these geographic restrictions on where banks can operate, you have to create these nationwide networks to offer credit plans at a national level to compete with Diners Club and American Express. And so it's kind of in that moment in the mid-1960s when the kind of availability of universal credit becomes much more widespread, where banks are trying to target middle-class households so that, the wives will use cards for shopping, men will use cards for travel and entertainment. And that's really when, at least for middle-class households, a kind of universal card becomes common.
And obviously the credit cards come later in the history, but was there anything about the New Deal regulatory apparatus for banks, which is when you have the first big push, was any of that relevant to credit cards as Bank of America is starting to send them out?
Yeah, the way that I see it is, so the New Deal, right, comes after these series of banking crises in the US where thousands of banks are failing in the late 1920s and early 1930s. And the effort is to make the financial system safe and stable. And one way that this happens is there's an effort to maintain state restrictions on where banks can build branch offices. So banks are confined within individual states. And states regulate banks, especially regulating the interest rates, for example, that banks can charge on loans. And so it's sort of those factors which in part drive banks to see credit cards, which are not restricted by geography, as a way to innovate around some of these rules. And so, if you're a big downtown bank, you have one office in Chicago, and all of your customers are moving out to the suburbs, the credit card offers you a way to reach beyond what would be the normal geographic limits of your market to reach those consumers. And so in a very real way, banks are adopting the credit card and using the credit card throughout the history that I tell as a financial technology that they can use to innovate around these rules. And so that's one part. And then another key component of the New Deal, which is important, is that it's in the New Deal where the federal government makes household borrowing an engine of economic prosperity in the US. So there's a variety of programs. The most famous is the Federal Housing Administration, where the federal government is really trying to get households to borrow to buy stuff like houses and all the things you put in houses, dishwashers, washing machines. And by putting consumer credit at the center of the economy, it then makes it legitimate for banks to also get into consumer credit and sort of push towards what becomes the credit card market.
And then, and by the way, just logistically, I'll go till about 5:15, and then I'm going to open it up for questions. So there will be an opportunity for that. What was the interbank?
So what you get so I told you this story about Bank of America, right? Bank of America is the largest bank in the United States. They want to build this network. And they end up partnering with large banks because as a large bank, they kind of understand working with other big banks. But what happens at the same time is other banks that want to get into the credit card market either can't partner with Bank of America or don't want to begin to develop rival networks. And so there's this process in the mid-1960s of competition and network building, where on the one hand, you have the Bank Americard and Bank of America, and then you have these regional card associations. So you'll have a credit card plan that all the banks in Chicago are signed up for, or a group of banks in the Southeast. And eventually these regional networks merge into something called Interbank, which is now MasterCard. It was MasterCharge for a while. And so you have this kind of network competition. And it's happening in terms of like how the banks are organizing themselves. But then you also get competition for customers, which follows a model pioneered by Bank of America. So Bank of America was a big consumer bank. And what they figure out is the best way to build a credit card market is to mass mail unsolicited credit cards. So in 1958, what Bank of America does is they do this in California. They have 2 million depositors across the state of California. They mail them all credit cards over a series of months. On the one hand, this is totally insane, right? Because you get this piece of plastic in the mail. You don't call with personal information to like activate the card. The card is active when it comes in the mailbox. You're meant to sign it, but of course, no one knows what your signature looks like, so anyone can sign it. And so the bank experiences a lot of fraud. They lose a lot of money because people aren't paying back the loan, but they stick with the plan. And they are ultimately profitable by the early 60s, and it's in 65 that they begin this nationalization project. And so when they do that, all of the banks that sign up with Bank of America learn this strategy: mass mail millions of unsolicited credit cards. And all of the banks they join Interbank also replicate this strategy. And so in the mid to late 1960s, tens of millions of unsolicited credit cards are being mailed to consumers across the country as banks are competing to get consumer households, because they're worried that the first credit card that you get is the one you're going to keep. And if you keep that, you're going to move all of your family's sort of business to whatever bank sends you that card. And so there's this insane process of competition that leads to consumers just being deluged with plastic in the mid-60s.
And so there's fraud early on and people aren't paying it back, I assume. Why didn't the banks care more about that more?
Well, they did care. I mean, it's complicated. Again, they kind of had this zero-sum idea about needing to get cards into consumer hands, needing to have access to affluent households, especially sort of white households in the suburbs. And so they recognized that fraud was just going to be a kind of part of it. But what they're also doing in this time period is lobbying for tougher credit card fraud rules. So something like, that I found really interesting is because credit cards were a new financial product, the criminal law didn't really work for prosecuting card crime. Because the way that fraud works is you have to deceive someone and through that deception, harm them. But with a credit card, you deceive someone by giving the merchant a credit card that isn't yours, but you're actually harming the credit card company who ultimately has to pay for this. And so what card firms are doing at the state level throughout the 1960s is trying to get new fraud legislation to bring the government in as a partner to help police the credit card market. And I think that's important because we kind of think that like markets maybe are spontaneous or they come out of nowhere. But what the banks are really doing is working very hard to get, really tough fraud laws to try to crack down on some of this fraud. And the government tends to take the view that, like, why are we going to police card fraud if you're mailing out millions of unsolicited cards? Like, maybe you guys should stop doing that, and then we'll talk a bit more about, how we as the government can help you protect this market.
By the way, you didn't do a cultural history, but how were people using these cards? Were people just buying things left and right as the companies are just sending you out cards? Or do you know if people were still restrained in how they used them?
I mean, I'd say anecdotally, most people are probably getting these cards kind of thinking, this is weird. What is this thing? And my sense is that they just sort of gradually begin to use them cautiously. But it's this thing, you don't automatically know how this works. And you have to learn how to do it kind of through practice. And so, like, I've seen in some of the court records that I've looked at, they actually have people's credit card statements. And you can see, like, the kinds of things that they're buying. Each of those, again, is kind of idiosyncratic. But my sense is that generally people are cautious and have to develop habits around how they're using cards. And you end up seeing people, you can think about this today, right? Are you the kind of person that pays your balance off every month? Or are you the kind of person that maintains a balance and is having to pay interest? And the banks are really paying attention to this, because if you're the kind of person that pays your balance off every month, then you're getting free credit from the bank, essentially. And so banks are then trying to figure out how to charge annual fees or to charge sort of usage fees when people aren't actually paying interest. And this is one part of the kind of larger fights about the cost of credit that are being fought out through the 70s and into the 80s.
I pay mine off every month, so now I feel good. Okay, so then Congressman Wright Patman comes in the story, famous Texas populist. What are his concerns about these cards, and what does he try to do?
Well, you have this kind of problem in Congress where, problem isn't quite the right word. You have sort of New Deal era representatives and senators. Wright Patman is the most sort of archetypal example. Patman is from, I think, Northeast Texas. He is a real opponent of the big banks, of the Federal Reserve. He sees credit cards as hugely sort of dangerous to both the banking system and to the interests of small banks, and he wants to ban them. You also then have in this moment sort of younger, more liberal lawmakers who didn't come of age during the New Deal, who are, I'd say, more interested in allowing for financial innovation. They're sort of caught between this problem of maintaining kind of the safety and soundness of the banking system, maintaining the New Deal era regulations, but also creating space for new consumer products. And when the credit card kind of comes onto the scene, these lawmakers are really faced with a dilemma, because there's this question of, like, who should bear the cost of innovation? You have consumer groups who are saying, well, we don't want to go into debt. They're mailing credit cards to our wives and daughters. Can you imagine this? We're worried about billing errors on our credit card statements. We're worried about fraud. We really want to control and regulate the credit card market. And on the other side, you have bankers who are saying, look, credit cards are this new innovation. Consumers are really going to benefit. We don't want fraud either. So if you just leave us alone and don't regulate us, we're going to work out the best way to offer this product. And you have lawmakers in the middle who are kind of torn between these perspectives. And eventually, because the consumer movement is so powerful in the 1960s and 1970s, consumers largely succeed in enveloping the credit card into the existing kind of regulatory system. So banks get into the credit card market, and credit card interest rates aren't regulated, and consumers succeed in getting interest rate regulations. They succeed in banning unsolicited mailing, in shifting liability. So even today, if you lose your credit card, you're only liable for the first $50 of fraudulent charges. That's a 1970s regulation that consumers succeed in. But there's this long debate in Congress as lawmakers are trying to balance consumers' interest in sort of safety in the marketplace and banks' interest in innovation, and ultimately they side with consumers.
And then can you tell us, I remember the kind of letters they send are important to avoiding any kind of restrictions. What did that look like?
So say what you mean again.
Didn't they start sending different kinds of letters to avoid any regulation with the cards?
Well, what happens? Yeah. So in 1970, you can no longer mail unsolicited credit cards, right? The physical piece of plastic. And so what happens in 1977 is Citibank, and I'll maybe kind of elaborate on this story in a minute. What they start doing is sending pre-approved offers, right? So it's not that you're getting the card, but if you check a box and send back the postcard, then they'll mail you a card. And so it's a way essentially to do the same thing, which is offer unsolicited credit. It just takes an extra step in that process.
And then then the Supreme Court weighs in 1978 with the Marquette case. Tell us what that is and its significance.
Yeah. So as I was saying, like when bank cards come on the scene, you have this big boom in unsolicited mailing. And you have this increasing attention that actually predates the card about high credit prices. So as I said, in the post-war era, the United States kind of builds its political economy on consumer credit. And consumers become increasingly worried that they're paying too much for credit, that they're paying 18, 24% interest. And so you have this large-scale lobbying campaign at the state level to limit credit card interest rates or limit kind of consumer credit interest rates, and credit cards get wrapped up in that. And so by 1970, most states are limiting what banks can charge on their credit card plans. But this kind of creates a problem because each state is making these decisions at the state level. So bankers are negotiating with other local stakeholders to make these decisions about what seems like a good interest rate in Iowa or Minnesota or California. But as I said, credit cards cross state lines, right? So if you're a bank in Nebraska, you might sign up customers in Iowa and you might mail credit cards into Iowa. And then you have this problem, right? Because you're in Nebraska, you want to abide by the rules that are in place in Nebraska, in part because it would just be too complicated, right? Imagine you mail a card to someone in Iowa and they use the card in Iowa. And so then you have to apply Iowa rules. And maybe they take a road trip up to South Dakota and then you have to apply South Dakota rules. The banks are just saying, like, we can't do that, right? We need regulatory consistency, in part because we're using giant mainframe computers and we can't calculate all these different rates. But because consumer groups and policymakers had fought to set interest rate policy at the state level, those consumers in Iowa want to pay Iowa rates. And the Attorney General in Iowa expects that banks offering credit cards in Iowa are going to conform with local rules. And so there's this sort of long series of judicial fights that begin in the late 60s and end in the Supreme Court in 1978 over which states' interest rate rules are going to apply. What the Supreme Court says is that where the bank is located, that's the rules that apply. And at the time, now this is like the most important credit card case now. At the time, it was not seen as very important because banks couldn't move. So even if this Nebraska bank can mail credit cards to Iowa or Minnesota and charge Nebraska prices, the Nebraska bank is still engaged in this local dialogue, local political negotiations with Nebraska stakeholders. And so there might be some differences. Nebraska, you might be able to charge 18% on the first $1,000 and then 12% after that. In Iowa, you might be able to charge 12% across the board. So there are like small and significant differences, but they're still small differences. And the banks are still stuck in place. But the dynamics change, which is your next question.
Citibank.
Citibank.
How do they capitalize on this?
So what Citibank does initially is they begin to see the credit card not as just a way to offer consumer credit. They begin to imagine the credit card as a bank. So banks can't build branches across state lines, but maybe Citibank, thinking in the late 70s, those rules are going to go away. And if we can get cards in consumer hands and have the card not just be a credit instrument, but maybe you can make deposits, maybe we can offer other kinds of consumer financial services, then we can build a consumer bank without actually building branches. And once we get rid of these branch restrictions, we can have a head start on our competitors in building a nationwide bank. And so in the late 70s, they begin mass mailing these sort of pre-approved offers to Bank Americard holders across the country. So Bank Americard is changing its name to Visa. And Citibank figures that no one's going to notice if they get their new Visa offer if it's from Citibank or their local bank. And so Citi mails 20 million offers. They get 4 million new Visa card holders out of having had none beforehand. And they're positioned to build this nationwide bank. The problem is that New York has really strict interest rate restrictions. And in 1979, this guy called Paul Volcker, who's chairman of the Federal Reserve, dramatically raises interest rates as a way to fight the kind of persistent inflation of the 1970s. And for Citibank, this is a huge problem because they're charging consumers, let's say 12% interest on their credit card balances, but they're paying 20% for the money that they're using because a bank borrows the money that it lends. And Citi builds its credit card business by borrowing money in variable rate markets, in the euro markets in Europe, through commercial paper, through other means, and lending that money to consumers. That works if Citibank's paying 4, 5, 6%. It doesn't work if they're paying more than they're charging. But they've made this huge bet on the consumer market and they can't really get out of it. And so what they try to do is find a state that will allow them to charge whatever interest rate they want. So in 1980, they're going back and forth with Missouri, with South Dakota, and ultimately they relocate their credit card business to South Dakota, where they can charge whatever interest rate they want. And this effectively ends states' ability to regulate credit card interest, because once banks can move, then that local political negotiation doesn't work anymore. Because the bank can just say, well, we're going to take all of these jobs and we'll move them to South Dakota or we'll move them to Delaware, which is really the biggest state for this, this relocation process. And so while you had this place-based social contract of finance that worked from the New Deal until the early 1980s, once banks show that they can move, this breaks down. And so consumers and other stakeholders at the state level no longer have control over interest rates through regulation, and they end up sort of being subject to the regulation of these least populous states where the banks relocate after
I want to stick to the 70s just a little more. How important is it that this takes place in the context of stagflation and really terrible economic times? How was the context of the economy relevant to how this was unfolding?
Well, part of it is that when Citibank launches its large kind of campaign across the country in 1977, the other banks just don't let this go. They also begin massive marketing again. So there's this kind of process in the 60s as banks are getting into the market when there's this massive credit card marketing blitz. And then in the late 1970s, you have the same process. And it's in the context of stagflation. It's in the context of the problem of inflation where policymakers are really worried that as consumers have access to more and more credit, they're using that credit to buy ahead of inflation, right? If you know that prices are going to go up, you buy the thing today. That then creates more demand, which then makes a self-fulfilling prophecy. So then prices do go up. Policymakers in the Carter administration are really worried about this. Carter spends his whole 4 years fighting inflation. Carter himself is a moralist. He's worried that American society is too concerned with consumption and not with more fundamental values of family and faith and religion. And as part of that, in 1980, he institutes controls on credit cards. So he's trying to limit the further issuance of new credit card credit. And this is coming just on the heels of Volcker raising interest rates. And so you have pressure on kind of the supply side, on the cost of money for banks. And then Carter's putting pressure on the demand side. He's trying to convince consumers to stop using credit. And from a political perspective, I think restraining the credit card market is a good idea. What Carter finds, though, is because the economy was so dependent on it, GDP falls by 8% when the credit card controls are in effect. And so even though he's trying to make this move to encourage Americans to restrain their use of credit, because the economy is too dependent, he has to back off of this almost immediately, abandon the credit controls. And of course, he loses the election in 1980. So any effort to control Americans' use of credit is effectively over at that point.
And it never comes back.
No, you see more often American presidents encouraging consumers to buy more. So after 9/11, for example, Bush is saying, go out, use your credit cards, spend into the economy. There are efforts now, both on the right and on the left, to reinstitute interest rate controls, and that comes up every so often. but there's never been sufficient political momentum at the national level to do that.
Why not?
I mean, I'd say because the credit card companies are powerful. So part of what has happened since banks began to relocate to these states is you see the consolidation of the credit card market in the biggest banks. So Citibank, Chase are the largest credit card issuers. They dominate the market. You also see that credit cards are among the most profitable service that banks offer. So the Fed releases a report every 3 years on the profitability of these sort of credit card units in banks and finds that credit cards are 3 times more profitable than sort of standard bank activities. So I think there's such political momentum on that side blocking it. And I just think that policymakers are rightly concerned that the economy is so dependent on this spending. There isn't an alternative political economy available that would produce the same results.
And there's lots of sources of credit and debt. How do credit cards compare to other kinds of credit that people depend on?
So I think about this a bit like through my own experience, right? So as a college student, I had this credit card. And when I ultimately paid it off, I paid it off with a student loan. Here's the thing. Financial historians are not obviously good with their own finances. So don't ask me for financial advice. But I actually see like one of the major responses after the financial crisis was this effort to regulate credit cards and in particular limit college students' access to credit cards. And I would say like you see in this period where credit card debt peaks and student loan debt continues to accelerate, certainly there are a number of factors that lead to the rise of student loan debt. But I think there's something to be said for people not having access to one kind of credit and substituting into another. And the problem with that substitution is like when I had a credit card as a college student, I still had to make those minimum payments. Like I had a connection to the balance that I owed that was really real. I would get those statements every month. With student loans, right, it's just like you'll pay it off when you're done. And so you can accumulate that debt with less of a sense of the consequences of repayment while you're accumulating it. So certainly while students are using student loans for tuition and all sorts of other things, to the extent that it's also playing a role in their day-to-day consumption, it's, I think, a real problem, and it's leading, I think, to that continuous acceleration of student loan debt.
When did the banks start sending it to young people?
So it happens, I think, in the 80s. What you get is the rise, on the one hand, I mean, you just get kind of all of these different strategies to get people to use their cards more. Yeah. So one is targeting college students, recognizing that even though you don't have an income today, you expect to have an income later. And so it'll be good to get you into the habit of using credit cards. And this is also something like growing up, like my dad was like, you should get a credit card to help you build credit. So you have this narrative about needing to develop your financial identity, to build your credit. And like on the one hand, that's kind of true. And on the other hand, it's kind of a trap. You also get in the 80s the rise of affinity cards. So the idea is like, okay, well now everyone's got a lot of cards in their wallet. How are we going to get them to use, our card over and over again? And so you tie it to organizations that you like. So the University of Georgia, in my case, right? I'm going to pull out the card with the UGA mascot. That's the one I'm going to use. Then you also get the development of, point systems, these other kinds of programs, which again are designed to get you into the habit of spending, into the habit of using one bank's card. They also, points in particular, make credit cards a kind of upward redistribution mechanism for people like you, Julian, who I'm sure are getting lots of points on everything that you buy, paying off your balance.
A lot of kids.
Yeah. So it's like, it's always been true that the poor pay more, and that remains true in kind of the modern credit card system.
And how does your story look compared to other countries? I mean, what's been going on in other parts of the world with credit cards?
So I think like the US is unique in the way that we created a payments card network through credit cards, right? So in Europe, you get debit cards largely instead of credit cards, and there's a lot more cultural hesitation around using a credit card to go to a restaurant or something like that. So I think it is relatively kind of US specific that we did that. In the UK, they also kind of have credit card networks, and credit cards become popular in the 60s and 70s. But often you access credit through your checking account. You have what's called an overdraft. And so college students will like get a checking account, put £2 in the checking account, and then go £1,000 in debt through their checking account using a debit card. Right. So there are different ways that people use cards to access credit. But I'd say in the US, it's relatively unique that our entire payment card infrastructure was really built around credit first, and it took much longer to get to debit.
Funny aside is I love to use cash actually, because then I know what I'm paying. And last summer I was near the beach and I stopped like at a farm stand to get something, and I handed the kid, who must have been 20, cash. And he looks at me in shock and he's like, "That's badass." So it's totally saturated the culture at this point. And obviously with technology, it's changed even more.
So I'm not recommending that you mug Julian after the event, but
So you're a historian, but you've obviously thought of regulations that were tried, regulations that failed. Do you think now there's room for any kind of regulations? Is there discussion of this at all? But what do you think in terms of what may alleviate some of the problems with the industry?
so I think like one policy that is on the table right now from both the right and the left, whether it will get any traction, is to reinstitute national interest rate limits. And on the one hand, I sort of favor that policy. I'm interested in that policy. But the challenge is what proponents of interest rate limits recognized in the 1960s when they got them on the books, which is that will automatically limit those who have lower credit scores access to credit. And so that means that people with less means, people of color who tend to have lower credit scores by virtue of the systemic sort of racism in society, which makes for less economic opportunity, it means that a lot of people will then lose access to consumer credit or will be pushed towards other kinds of credit which are more expensive and more problematic. And so the challenge that you have when thinking about a policy like that is you say, okay, well, it would be good if our society wasn't so dependent on credit, if people weren't have such risk in day-to-day spending. But then you have to ask the bigger question of then what do we do to substitute for that or to make up for that? How do we create social policy that fills the gaps that would then be created? Because, I told you the story about how once college students lose access to credit cards, my hypothesis is then they pick up student loans. If we limit interest rates on credit cards, that means that only the most creditworthy will have access to them. So then what do we do for all the other people who lose access to that form of credit? And so that's where I think like narrow policy can maybe cause more problems than it solves. Like my number one policy proposal is ban credit card points. So stop giving Julian free trips.
You're really beating up on your advisor.
Yeah. Well, I mean, because I think like that is a socially problematic policy. But of course, all the people who make laws are the ones who are benefiting from that. So it's just impossible, I think, to get that policy through. But that would be my kind of first policy perspective.
Do you think, I want to open it up for questions in a second, but is technology basically going to render cash irrelevant? You go into restaurants and stores, fast food places, it's credit only. Obviously, it's on phones, so it's easy. Will we hit a point where they're totally triumphant, the credit card? We don't have pennies anymore, so maybe.
I don't know. I think that, when it's a card only, I think that was kind of common in New York, and maybe it still is, where that's a problem because some people don't have bank accounts, right? People don't have financial access. And so again, unless you're creating a system where you're ensuring that people have some means of payment that they can use at a point of sale terminal, some people will still need to have cash. And so stores will still need to accept it. It's hard to imagine creating a national system where there's we have access to Federal Reserve accounts or something where we have a Federal Reserve debit card. That would be great. What Well, I don't know. I mean, I think that's right. It's an open question. There's huge questions about privacy, right? A good reason to use cash is because you don't want people to know what you're spending your money on. Julian, this might also explain why you have a lot of cash in your wallet. So, I think that like until we answer some of those questions, it's not obvious to me that cash will go away. But other countries, try to do this, right? India really did a big push to get rid of at least a lot of the cash in its system and switch over to digital. And so there are examples where in other places this is happening, but we love freedom in America, Julian. And I think that like not having cash is going to really rob us of that.
And finally, so you started this whole project with your own credit card debt. You've been working on this for years and kind of gone into this in more depth than anyone I know. How do you kind of look at credit cards differently from when you were a kid at UGA?
I mean, I kind of like try to hold two ideas in my mind at the same time. So on the one hand, like I think that the current credit card system is really problematic. I think that the way that it encourages high interest household debt, the way that it can be specifically harmful to people who get into trouble, just as a kind of social technology, I think it's not ideal, and the structures that we built around it are not ideal. At the same time, like I went to Paris a couple years ago, and it's the first time I've ever seen one of those sort of tap-on subway systems where you just pull out your credit card and you tap and you go on the subway. And there was a kind of feeling of magic. And it kind of, in some way, helped me imagine what it was like to get that first Bank of America card in the mail that was made of plastic, that you could go to a store and hand this card over and then walk away with stuff. And so there is this kind of magic in the cards that even I, as a cynic, can appreciate, like the way that technology does make some things easier or more convenient, that there are real benefits that come through this innovation, even as we have to think really hard about the kind of social policies that we want to put in place to make the innovation work, best for the most people.
Okay, I want to open it up. And I want to also say Sean is so impressive. Not only has he put this book out, and he has another book coming out with another former student, Peter Conti Brown, that's coming. When's it coming out? On bank supervision.
In June.
In June. So this guy is a hard worker and with difficult subjects. Harold. Good job.
In your discussion, you didn't talk very much about merchant fees, but this is surely a big part of the controversy about it, because for most businesses, except maybe for gas stations, the price that you pay if you pay by credit card and the price that you pay if you pay by cash is identical, but the merchants are getting less if they do the credit card, and there are big spreads on that, and that's a theme that is obviously an enormous issue for small businesses and the business community, but it doesn't really appear very much in the controversies that you talk about the interest rates. And then the second one was just a sort of, in a way, a version of the question about other countries. When you think of your original story of where the banks are situating these credit card operations, how much employment does it generate there? So the question is motivated in part also by my own puzzlement. When I came to the United States in the 1980s, so this was before you could pay online and do things like that. So you had to put a check in the mail. And the address that I got to put the check in the mail was an address in Jamaica, Queens. And it was clear that it was actually sent then to a post box where it was all collected and then processed in Ireland. Basically the employment that was generated out of this whole business, and it was manually very, very intensive, was something that you did in kind of low employment areas in the west of Ireland, because Shannon Airport was really, really, really big at that time. So those two questions, I would be interested in your answers.
Yeah, so yeah, you have the merchant fees, which are always part of this system. So from the very beginning, banks, when they develop credit card plans, are offering cards as a service for merchants and saying this is a way for you to offer credit to your customers that you wouldn't be able to do on your own. And so merchant fees start as high as like 8%. So you pay $100 for something and the merchant gets 92, right? That's really steep. Over time, these decline as credit card plans get bigger, as the volume increases, but it still remains 3 and 4% throughout this period, and really, depending on the merchant or depending on the card issuer, to the present. The pitch that card issuers make is like, well, if someone is using credit at your store, they'll buy more. So you actually, even though we're going to take some of the purchase price, every consumer that's using a card with you is going to buy more from you. And so you actually get an advantage for taking this card. Now, once everyone accepts credit cards, the logic of that doesn't hold. And so you get these long fights through, especially in the 1970s, where inflation is a big issue, where there are these debates about whether the merchant fees themselves are inflationary, whether merchants are increasing their prices by some percentage so that people who are paying cash are subsidizing people who are paying with cards. But it's like a really hard problem to solve because it's really irritating as a merchant to like give someone a 5% cash discount. It's also the case that cash isn't costless, right? So you have to worry about handling cash, about loss from theft, about, going to the bank and getting rolls of quarters every week. So I don't think that there have been, or I didn't really focus on that aspect. I imagine there are studies that really break this down. The real political momentum around this comes in the 90s when you get debit cards and big retailers like Walmart begin suing banks over sort of anti-competitiveness, that once there are two monopolistic networks and it's the only card that you can take, then there's a lot more political momentum around this question. And again, it continues to be an issue in Congress. And then the second question about employment. Yeah, so it's not coincidental that the main credit card states are South Dakota, where in 1980 they have the lowest wages of any state for non-farm employees, a state that's devastated by agricultural decline. So there's real sort of incentive to try to find new industries. And then Delaware, a state that was ravaged by deindustrialization, right? So they're also looking for new ways to generate employment. Now, most of the employment in these for these cards, for these firms in particular, it's like call centers. It's often largely female employees. So I have this video from Citibank's 25-year anniversary in South Dakota, and it's all women in the audience who are working in these big call centers in Sioux Falls. In South Dakota, I think they say that 15% of the state's GDP is tied to the banking industry by the 1990s. So it really is a significant industry within these states. But I think you're right, Harold, that like you can kind of think of it as all the real executives are still in New York, right? The power and the sort of the best paying jobs are still in the financial centers. But this is where you're sort of pushing bits of the corporation out into lower wage regions where you can find cheap labor, and with this sort of regulatory advantage on top.
Maddie?
Okay, I have the
okay.
mic so you can come to me.
Yeah, you're next.
So thanks for all the research you've done. On the first question that was asked, like I'm paying cash in some places because they're going to charge me 3% more otherwise, and I just find that offensive. So I don't know how widespread that that's going on. When you think looking forward, what about the use of blockchain and crypto in this network somehow? You talk about this. Is there privacy with what you're buying if there was a card that's tied to, your crypto account? I mean, I'm not following it, so I don't know where things stand in that space now. So where do you see things going?
That's a good question. I guess so I haven't followed this closely either, but what I think is interesting, or what I wonder about, is one, whether the big networks, so especially like Visa and MasterCard, would be able to support crypto and how they would do that. It seems like it wouldn't be that difficult for them to do, but they're interfacing with large banks. They have sort of their technology for transferring value is based around sort of normal currency accounts. And so I don't have a sense of the technological challenge that would create. I think another possibility would be that you could get new networks. And I think that would be like, if I was a crypto enthusiast, I would tell you that's what we're going to do, that we want to try to challenge these monopolistic, Visa and MasterCard and create new networks that people can use that will charge lower fees to merchants, that will be free to consumers. How realistic that is, I don't know, because the infrastructure that it takes to run a global payment system is massive, right? That's why we tend to have these as large monopolies, because it's really expensive to build a global payment system. And so how easy it would be to develop something, an alternative through crypto, it's not clear to me how that would work. I think it could work online more easily than offline. And that may already be live in some kind of corners of the internet. But I suspect like the day when you'll walk in and maybe tap your phone and pay in Bitcoin or its equivalent at a coffee shop are still some time away. But I'm happy to hear if people know more and can tell me that I'm wrong about that.
Maddie.
Thanks. I feel like I'm committing the cardinal rule of a mic runner, which is to ask a question. But I'm 20. I've written a check once in my life. And I'm wondering, what are some of these like social conventions that maybe are not obvious that you've picked up in your research? Like, has the architecture of the wallet itself changed when people now need multiple pockets for multiple credit cards? Is there like a feeling of weightlessness going to the movies in the 80s when people only have one card to carry?
So there are patents. So when credit cards in the 60s, when they become popular, you can actually see people patenting wallet designs for credit cards. So there is, I think there is a transformation in the way that you're engaging with money. And that's like what credit card enthusiasts are talking about in the 60s is they're saying, well, what we want to create is a cashless and checkless society. In part, that's because processing paper is just really expensive. So banks are having they call it the back office crisis in the 1960s, because it's so expensive as Americans are writing billions of checks a year to process all this paper. And the promise of credit cards is like, well, with giant mainframe computers and with credit cards, we'll be able to get rid of all this paper. But it doesn't work out because the credit card system originates with the carbon paper, which I'm sure that you have never seen, maybe, but I was at the Reagan Library and I was in an Apple store and the power went out and they pulled out this machine where you would have these carbon copy. There's sort of 3 pieces of carbon paper together and you put your card underneath and they run this thing across. So at that point, cards were embossed. They're not always embossed anymore. It would take all your cardholder details onto this piece of paper and then 1 copy stays with the merchant, 2 copies go to the bank. And in my case, because I wasn't because I was in New Jersey, they then would have mailed one of those pieces of paper to my bank in New Jersey so that my bank in New Jersey would have a record so they could then put it onto my account, right? So there's this ocean of paper that's created by the early credit card system, which almost destroys it because banks aren't prepared to have to process all this paper. And so in the way that the new technology held out the promise of getting rid of cash and checks, it actually made more paperwork and caused more issues, at least in the short term.
Thank you.
Hi, thank you so much for this talk. I wonder if you could speak to the geopolitics of plastic today. So I think of digital currencies as one bullet point there. Another are these sort of digital public payment systems that are now spreading around the world. You mentioned India. My experience there was this sort of befuddlement of paying for a mango for 10 rupees in a rural area in the middle of nowhere on my phone in a country that seems to be more advanced in digital payments than the US in many ways. And if you talk to Indian government officials, to anyone who listen, they will talk about digital public infrastructure and UPI, their payment system, and how it's so amazing. Of course, it's not in India, just in India. Brazil has PIX, South Africa, Peru, Chile, 20 countries or so, depending on how you count, have these kinds of payment systems. And the story that I've heard about them is that MasterCard in particular is sort of the most vociferous opponent of these systems and sees its business model in some sense as sort of existentially under threat by them. So like two questions there. One, do you think that's true? Do you think plastic is sort of at the end of its life? And then The second question is, what are the parallels that you see between the kinds of consumer credit ecosystems that are emerging around these digital public payment technologies and the credit ecosystems that come out of the credit card world? Are we entering a world of better credit in some way, or a sort of a darker world of some sort of like even more scary sort of unimaginably complex credit systems that are emerging from these new payment technologies, which don't have the ability to monetize transactions, so have to kind of find money in other places?
Yeah. So super interesting. A lot of questions in your questions. So I'll answer it. I don't know. So what I want to start with is to say what makes the US sort of unique is that we have this highly fragmented banking system. And that's why we end up with the networks. And what happens over the course of the story that I tell is you get this, initially the networks are owned by the banks and they kind of are aligned, but eventually the networks become sort of their own entities, right? And so the interests between the networks and the banks are not always as complementary. And you have this tension, especially with big banks that want to develop their own technology, their own payment systems, and the networks, which are trying to develop technology for all of the banks, including the smallest ones. And so a consequence of this, for example, is why it took us so long to get chip and PIN in the United States. So chip and PIN, you have a chip in your card, you have a PIN. They had it in Europe for a long time before it comes to the United States, and that's because the mag stripe was so cheap and the small banks wouldn't support the sort of what was needed to do the new technology. When they invented the mag stripe in the 70s, Citibank did a contest at Caltech to say who can hack this. And 19 students figured out ways to hack the mag stripe before it even became commercially available. So they always knew that it was a disaster in terms of, consumer protection and fraud. But that's what the American Bankers Association went with because you have this constituency of all the small banks. And that's like, I'm giving you that response in a way to get to say that I think that like the bankers and the networks would fight really hard against any kind of national public payment system in the United States. So there are a lot of people who are advocating for, as I was mentioning, like Federal Reserve accounts, where you could imagine having a Federal Reserve debit card. But both the banks and the networks would resist that. And then I think you're right that more broadly speaking, the networks do not want public competition, especially if you're creating sort of nationwide systems like HICS. The kind of question about the other forms of credit that are emerging, like I think about things like Klarna, which I think are terrifying. And as you have these sort of disaggregated digital payment systems or credit systems, I think you're replicating the problems of the early credit card market, but there isn't an impetus to regulate them. And because they're global in scope, it's hard to know who's going to have regulatory power and oversight over them. So I worry that like that will be a source of some form of instability as those companies get too big, offer credit too freely as they're in competition with one another. And then if one of them fails, what the consequences of that will be.
Okay.
Well, thank you for a wonderfully lucid and enlightening lecture. And I know Viviana would be very pleased because you've identified new kinds of money and their social meanings. So I drove in to hear this lecture because of the juxtaposition of plastic to capitalism. And could you say something about the ways in which plastic is being used to create capitalism? The only examples I know of are various young entrepreneurs who use cards to build up their early capital for their business.
Yeah, so I'd say two things to that. One, the title in part is about how capitalism itself reforms and remakes itself, about how firms especially use technology to morph around or shift around regulation. But my dad, when I was a kid, started a printing company. And he started that printing company with 10 credit cards. And he rolled over the balances month to month as he was essentially using those credit cards as a form of working capital for his business. And I think that's not an uncommon story. I mean, you told the story. So like it's a thing that people do, and it's part of this larger narrative about small businesses struggling to access credit, which has been a large political concern in the United States really since at least the sort of early post-World War II era. And this concern, especially that big banks don't give credit to small business. It's not worth their time to investigate whether the business is going to succeed or fail. And so credit cards offer a way, a kind of a loop around that for some kinds of entrepreneurs. Of course, it's incredibly risky. It's expensive. But it is a way that people are able, to start businesses.
We have time for a few more questions. Buddy.
Yeah. Thanks so much for the talk. I've got a few quick questions. You can answer the ones you find most interesting. I'm curious about the fraud protection. Why did the default structure benefit consumers so well? You talked about the legislation in the 1970s that consumers were protected. They were only liable for $50 of fraudulent charges. But even before then, you seem to imply that if a fraudulent charge went through, the banks would foot the bill. You could envision a world where that wasn't the case. And then on the merchant fees and the vendors, why didn't we see much more of a pushback from vendors? I know it's a bit of a strawman argument to talk about Discover, but like you can imagine where the Costco's, the Walmarts, they get together. I mean, they've probably found out another solution with their own Visa, but get together and lobby for lower merchant fees or something like that, or an alternative payment system. And then when we think about substitutability for credit cards, as you mentioned, cash is not costless. But what are the, like, if we're just thinking creatively, what are the kind of pitfalls of that replacement system? What we'd have to be looking out for privacy? Is the Federal Reserve style payment system like a nationalized public good? Is that the kind of idealized system that you envision? What are your thoughts about the things we'd have to be thinking second and third order about?
Yeah. So great questions. So in terms of fraud, what banks are trying to do in the 50s and 60s is, on the one hand, get merchants to be the kind of frontline fraud police. So checking the signatures, making sure everything is in order. And what banks threaten to do is to charge merchants back if there's a lot of fraud or to revoke their access to the payment system. But of course, banks don't want to do that because they need as many merchants in the system as they can have. And so there's a lot of kind of threats around it, but it's unclear how often that would happen unless there was really egregious errors. At the same time, banks want consumers to be the first line of protection of your card. So you want the consumer to report the card as stolen the second that they can. You want them to have this incentive. But for the same reason, right? The banks don't want consumers to go to the newspaper with a story that, my credit card was stolen out of my mailbox and there was $1,000 in charges and now the bank is making me pay, right? And so part of what's happening is as banks are trying to get the government to be more engaged with fraud, they're also willing, I think, to cede the ground to consumers on limiting fraud liability. And so what happens is you get this kind of risk shift where limited liability laws shift most of the risk of fraud from consumers onto banks. And then tough fraud laws, in theory, shift some of the policing costs from the banks onto the government. And so there's this effort, again, as you're trying to create an environment where you can innovate and create a new credit card system, you're trying to think about how to allocate the risk of fraud across these different stakeholders. And so $50 seems reasonable. It's enough that consumers aren't going to be really upset or put out if they have to pay it. Banks tend not to even enforce that anyway, but it's enough of an incentive to get people to call the bank if they lose their card. Could you remind me, so your other two questions? Yeah. Yeah, I mean, I think the merchants, especially the big merchants, have tried a variety of tactics to pay less. Initially, banks would offer discounts if you were a high volume retailer, you would pay a lower fee. But there's all these kind of antitrust issues that are baked into these questions, especially about favoring one class of merchant over another. And so I think outside of Discover, which is an effort to take the Sears card and make it into a national payment card, I think so many people use the existing payments infrastructure that it'd be too hard to create a Walmart card. So they've just kind of had to fight this out, both through the legal process and just kind of through contract negotiation. And then I see the privacy concerns with like a Fed payment system, and that's why I don't think that it has would gain political momentum. I just don't think that you could get something like that through Congress, and the Fed would never take that project on without explicit instruction, I think, from Congress. So I think you can imagine state level versions of this. So as you look at like the public banking movement, for example, I think one way that could gain momentum is if a state used its public bank to give citizens accounts and then pay like state tax rebates through that system or pay state benefits through that system. So I talked to some lawmakers in Maryland about this several years ago. And I think that would be interesting and like a useful test case for whether this kind of thing would work and be viable. But at a federal level, I don't think that it's politically viable at all.
Yeah, thanks for this. My question is kind of piggybacking off the public payment system, central bank digital currency questions, which obviously in the US we don't have, but we do have a growing Wild West of payments. You mentioned Klarna, Buy Now, Pay Later, Venmo, PayPal. I'm an economic anthropologist. I've worked with tons of consumers who use those services as banks. If you say, what bank do you use? They say PayPal with no, and some of those people are unbanked, don't have access. Others don't trust banks, but they trust these non-bank lenders. So my question is, and obviously we're seeing rampant fraud, predation through these services, very little legal protection for people who use them. You talked about this period, this regulatory question in the 60s and 70s of how to shift the liability off of the consumer, and real success that we still have today, as you were just discussing. So my question is, do you think there are any lessons to be learned from that previous frontier of a new payment system that can be applied to the current one? Or did that just happen to coincide with a moment of enhanced consumer protection that we obviously left long ago and maybe just isn't coming back?
I mean, I think the moment is really important because you have labor unions are still strong and take on a very assertive consumer protection stance, especially around credit cards. And you have a consumer movement that has gained significant momentum in the 60s and into the 70s, where politicians are explicitly saying, like, we need to do this because this will get us, we need to regulate credit cards because this will get the consumers on our side. And this is both Democrats and Republicans who take this view. So consumer protection, I think consumers, it's unclear which party they're going to fall into in the 60s and 70s. And so it gives them enormous power in Congress as lawmakers across the political spectrum are trying to appeal to them. So I think the moment is important. What I also see is like the CFPB was trying to do this, right? I think. Yeah, so there's a lot of discussion in like the FinReg, like financial regulation law literature, and among those people about things like, Venmo is not a bank and it's not FDIC insured, and like, what do you think is going to happen if it fails? Same with PayPal. So there's a lot kind of active regulatory conversation among academics about these issues. And I do think that like the CFPB really took this stuff seriously and was gradually trying to expand its reach to have supervisory oversight of these firms. That is over. At least for the next 4 years. If the CFPB makes it out of the Trump years intact, then we'll see what the possibilities are. Again, I think that then it's to the states. I mean, I don't think I've made this point through the talk, but maybe not strongly enough. part of what the book is really interested in is the role of states, that we tend to think about financial regulation as a national concern, especially after the New Deal. But the states exercise enormous power and have taken on to themselves enormous responsibility throughout this period. And I think even today, in areas like this, state attorney generals and state legislatures can take steps around these products that, if it's a big enough market, if it's New York or California, can have national consequences. And so I would imagine that going forward, organizing around these issues would be most useful at the state level. That's what I would say.
So we're almost out of time, but we'll take one last question. And then, Sean, there'll be a reception. You can ask Sean whatever you want. And you can purchase a book. Do that. And he can sign it too.
Oh, your thesis that student debt and credit card debt are fungible, like the New York Fed was actually looking into that. They were worried about exactly that in the 2010s, and the people who work on their consumer credit panel were sort of noticing things that didn't seem right. And so there were some internal discussions at the New York Fed about that at the time that they never published. We've been talking until now about regulation around consumer protection, but there's sort of another regulatory question with credit cards, and it's coming up with Klarna now and with other forms of loans. There's also a monetary policy question. And I'm wondering, was over this whole time, this period where we're talking about the protecting consumers from credit cards, was there a parallel conversation about how do you make sure that you are controlling the inflationary or deflationary aspects of expansions and contractions in consumer credit on a type of loan that kind of didn't really exist before?
Yeah. So it's a great question. So from World War II going forward, U.S. policymakers are concerned that consumer credit feeds the booms and the busts in the economy, right? Because you can imagine, as the economy is doing well, you're buying with your wages and you're buying with credit. And then once the economy tips down, you stop buying with wages and with credit. And so it magnifies the swings. And so part of what policymakers want to do is they want, as the Fed is trying to raise interest rates and kind of slow down the economy, they want consumers to respond to that. And there isn't a way for them to do it. So the reason that we have truth in lending in the United States, so the idea that when you get your credit card statement, they tell you what the interest rate is in a simple annualized term. The reason we have this is a guy called Paul Douglas, who was a senator from Illinois, who was a University of Chicago economist before he became a senator. He thought that if we give consumers, tell them what the interest rate is, then as the Fed is adjusting monetary policy, consumers will respond if they see credit prices go up, and they'll begin to slow down spending in line with what the Fed wants them to do. What Douglas realizes very quickly is that this is not a politically viable project, that no one in Congress is going to support truth in lending as a monetary policy sort of trigger. And so it becomes a consumer policy. It becomes about consumer protection. But the initial effort is this. And then, sort of going forward, there's always this concern about, the worry that sparks Carter's credit controls is that even as the Fed is trying to limit, to slow the economy, to slow inflation, well, consumers are getting deluged with these credit card offers and they're spending on credit even though we're trying to slow them down. And so there is, I think, a constant concern about in Fed speak, right, the channel of monetary policy to the consumer, and that it just wasn't really working.
Well, thank you, everyone. And to Sean, the great thing of teaching at Princeton is really the students, the undergrads and the graduate students. To work with someone like Sean is just unbelievable. A great mind. And it's nice to sit here with him many years later and hear you talk. So please thank him. Buy a book. Say hi to him.